This is Duke University.
Rich currently is the CEO of Advanced Liquid Logic, which is actually his third startup company where he has served as the CEO. Advanced Liquid Logic, the technology comes from a Duke spinout, and it's exploiting a novel microfluidics technology that the company's applying to medical diagnostics and other markets. It's a very interesting thing. They're taking the concept of a lab on a chip with a big monster type of machine and putting it on a lab on a chip that you can fit into your pocket. And it really is just a small type of component that you can carry around, basically. This is interesting for us, and specifically for this talk, for financing, because Rich, with this company, has raised over $25 million without any type of traditional VC funding involved. But before Advanced Liquid Logic, Rich was the founder and CEO of Triverix, which is a medical equipment contract manufacturer. Again, also a lot of great things going on in the financial side with Rich there, where he raised over $40 million in private capital and completed 3 different acquisitions. But it all started when Rich was here back at Duke, and he completed his engineering degree. He would go on to spend 15 years in aerospace industry, and even serving 4 years as a commissioned officer in the U.S. Air Force. An interesting link that sort of a funny tidbit that I realized when speaking with Rich is that while he was in aerospace, he worked on a missile, the TOW-2 Bravo, that I have actually fired from when I was served in my time during the military. So we won't talk about any missiles or things like that tonight, but we'll let Rich come up and we'll get some good information that might be able to help you with your startup company and getting it financed. So thanks, Rich.
So outline of the talk, very basically talk a little bit about how much money do you need. Rich, I'm not sure your mic's on, is it? How's that?
Yep.
Brian? Okay. Oh, there you go. Right. So how much do you need, where, and how do you get it? And then I'll walk through a couple of the companies I've been involved with by way of case study. Where did we get our money? How did we get it? First of all, apologies for gross generalizations and wholesale simplifications. Things like how does equity financing work? That's a course, not 5 minutes. But I do have a couple charts, and this is definitely introductory on that and other topics. And I do have opinions, so I will act like I know all the answers. I don't. But after a couple semesters teaching over in the MEM program on entrepreneurship, I have to act like I know it. So, and then I was obviously not solely responsible for either raising the money or the success or failure of the companies I've been involved in. So it always takes a village to make these things work. So anyway, I like to think of everything as a process, financial resource development process in this case. So start here by defining what you need. Find some alternatives for getting it. Make a plan and test that with people that know a little bit about it, and then make it happen. And then you go and do something else for a while. I think as an entrepreneur, what you find out is there are always many too many things to do that you have time for, and you sort of cycle your way through raising money, securing the intellectual property, developing the product, building the team, raising money, and around and around. And so, fortunately, raising money usually comes in lumps, if you're lucky, big lumps, and you don't have to worry about it for a while, but it's not something that goes away because generally people won't give you all the money you need at one time. It's an episodic kind of thing. So that's the process. Now, how much do you need? And this varies a lot by the type of enterprise that you're trying to start. Minimum investment here, for a Mac laptop and several weeks of pizza and Coca-Cola, you can develop a Web 2.0 business. If you want to get a therapeutic, say a pharmaceutical on the market, you might be talking about $1 billion. And in between there, you have everything else. I'm currently involved in a medical diagnostic technology. We're probably looking at 25 to 30 million to get a product on the market. So it does take capital. That doesn't mean that's what you need to start. All you need is guts to start, but it does mean that to get something on the market, you're going to need money on this order for these kind of businesses. So the way you go about this, get out Excel or your business planning software that you got for free. That's good. And build yourself a model that has assumptions in there from the bottom up. How long is this going to take? How many people am I going to need? Keep track of what it is you assume. Look ahead a number of years. Build an income statement, a balance sheet, and most importantly, cash flow. Where's the money going to go? And then visually summarize some of the key inputs and outputs. And as you develop your business, this will change often. I spent the last 3 days at Advanced Liquid Logic revising our financial model based on some assumptions that changed. In the last month, we got a $5 million NIH grant and acquired a company that we hadn't expected to acquire. So there's some money in and some money out. And so you have to keep this alive. This is an example of maybe the most important graph of your company. What happens here is you spend money over time, and this is the, say, cumulative amount that you spend, and eventually you start to make money. And how, sort of what the area under this curve is, what the maximum dip is on your cumulative cash flow, that's one of the most important ways to measure your company and what is going to be required. It's how much money you need further defines what kind of sources you're going to have to get your money from. So build a model, build it from the bottoms up so you know what the assumptions are, and keep it alive as you develop either your ideas for your business or, we're 5 years into Advanced Liquid Logic and we're still living off the same Excel spreadsheet. It's got a lot more tabs than it used to, but it's the same model. The other point here is minimize what you need. Frugal and entrepreneur walk in lockstep. So that's about minimizing the scope of what you do internally to the firm, minimize your internal expenses, and probably most important is execution. That is, if you hire 10 people and that's costing you $100,000 a month, and you had a certain plan for what you're going to get done this year, that's $1 million, give or take, that you're going to spend. And if it takes you 18 months, that's 50% more money. That's the cost of the marching army. You have these 10 people that are working, and how long it takes to do things is a critical element of how much money it's going to take you to get to the end point. So it's not just about getting the money, it's about making the best possible use of it as well. You build value incrementally, and you finance the business incrementally too. So this is not a smooth curve in reality. This is, oh, got another $1 million in the bank or another $10,000 in the bank, whatever it is. You got your product to a certain level of sophistication or development, or you filed a patent or whatever it is that increases the value of your company. All those things happen in steps, both on the value that you're creating and the money that you're bringing in. And know your runway. Your runway is how much money do I have in the bank divided by how much money am I spending every month. So if I have $1 million in the bank and I'm spending $100,000 a month, I have 10 months left. So know what it is. You don't really have the opportunity to ever get comfortable because most people won't give you enough money to where you don't have to worry about this for a couple of years. You know, if you have a runway of 12 months, you're in decent shape, but try to keep it at 12 months by incrementally raising money, by reducing your expenses, by spending less, by making more on early products or whatever. There are a bunch of different places you can get money. Founders, you have the money. Some of you do. There is no better source of money than customers, but you have to have a product or a service that's ready for that. You know, in a pharmaceutical business, you know, that takes a dozen years or so. In some businesses, you know, you can get there a lot earlier. You can get an early customer. You can start funding the company with customer money. My first business was a service business. We had 3 or 4 customers, you know, 12, 18 months into the business. Friends and family, usually that's friends, family, and fools. Our business associates will often help fund your business. Government grants, I'll talk a little bit about what our current company is doing in that regard. Angels, an angel is an individual that makes investments in companies in exchange for stock or a percentage ownership in the company. Venture capital, they're also buying stock or equity in the company, but this is an organized business whose purpose is to buy the stock in your company and earn a return for the people that have invested in their company. Angels are, on the other hand, individuals. Strategic partners, and we've closed so far one strategic deal at ALL with a large diagnostics company. And so they're generally big businesses that make investments in small companies or fund feasibility studies. They want to get an early look at your technology. They want to hedge a bet that might be the next technology in their industry. And so even relatively early, you can get some money from strategic partners. Banks and loans, there are things called venture banks that will lend money to relatively early stage companies. There's also, you know, Bank of America and Wachovia. They will not lend money to early stage companies unless you want to sign over potential ownership of your house if you don't pay back the loan. Suppliers in the later stages, you can borrow money from your suppliers by paying them late, and you can even have them agree to do that, maybe in exchange for an increase in price. I've done quite a bit of supplier financing in later stages of businesses. Private equity firms are grown-up venture capitalists, and then of course there's the IPO, the initial public offering, where you sell the stock in your company on the public markets to the public, and that is often hailed as, you know, what an early stage company wants to achieve. For every company that sells their stock publicly, there are, I don't know, 40 or 50 companies that are sold to larger companies. So in terms of getting these guys that bought stock in your company their money back, there has to be some kind of exit, that is, you sell your company or you go public, and by far the most frequent way for them to get their money back is for you selling your company. Sources of finance here, just a different way to look at it. Some are useful early, some only happen late, some involve selling stock in your company, some don't. And so early on you have founder financing, and then on the equity side, friends, family, and fools. Government grants and customers are non-equity sources. Angel funding can come in relatively early. We got some angel funding into ALL at about the 1 year point. And I'll have some statistics on all these sources of funding coming up here. Sometimes angels band together, so you have a band of angels or an angel group. There are also some special economic development programs. The North Carolina Biotech Center for things in biotech gives grants and loans to early stage companies. And then you have venture debt and venture capital coming a little bit later in the process. Suppliers, factoring, which is basically selling an invoice to somebody who will lend you money for that for an outrageous interest rate. And then strategic partners. And then, of course, much later on, bank loans, IPOs, and such. So some sources of money, these, you are giving away ownership in your company and potentially control over your own destiny, but you're getting money just for stock. In other cases, government grants, for example, you're exchanging money for a project. You have to do the project. Customers, again, the sooner you can get customer money, the better off you'll be. So where do these funds come in? What phase of development of the company? For a technology-based company, very often technologies are incubated at universities through government grants. And this can happen pre-company. In Advanced Liquid Logic's case, the technology was invented 5-6 years before the company spun out of the university. And so there was quite a bit of intellectual property and progress made on the technology before the company had to fund that. It was funded by the university and mostly through government grants. And then once you form a company, that's where you're into your own money or your own time invested in lieu of money. Family and friends, government grants, these special programs, state loans and that kind of thing. And angel financing is also relevant early. When you're moving your technology to a product, again, you're still in angel financing and government grant range. When you're getting a little bit later stage, now you can talk to strategic partners, venture capitalists. Angels are still relevant in this later phase as well. Growth and expansion phase, you've got a product on the market. You can still get VC money, strategic partner money, and some of these later stage funding things as well. But a couple of things to note here. Venture capital is, particularly over the last several years, has moved, we call it downstream. They get engaged later in the process. It's not something that generally you think of now to start a company with venture capital money. That comes later. There's lots of time in between when the typical venture capitalist will join a company. You have to get money elsewhere in order to get your company to a stage where a VC would invest, typically. So here's the stool theory of early stage financing, and the message here is that 4 legs on a stool are better than 1. And it really is that simple. The idea is which stool is easier to kick over, or if the wind blows really hard. A stool with only 1 leg may not make it. And I think in the current economy, it's a great example. As of since last September, venture capital money, for example, has been really hard to come by, even for companies that already had venture capital money. There's a lot less money being invested in that sector by pension funds and other traditional investors in venture capital. And so lots of very good companies were being abandoned even by the funds that had originally invested. And so if you're a one-legged stool company, even if that's venture capital, it's not necessarily a secure way to move a company forward. However, if you have a number of legs here, and we have some private equity money, we've raised $5 or $6 million from angels and angel groups, but if I had to get any of that in the last year, I would have been out of luck because those guys are not investing right now. But fortunately, we have a three-legged stool, not a four-legged stool, but I couldn't find the clip art for that. So, actually, we aspire to get a fourth leg as well. I'll talk a little bit about that. Common early stage funding methods. So here's how equity financing works, and some of you may already be familiar with this. When you form a company, let's say I form a company and I want to own the whole company. So I go to a lawyer and fill out some agreements and such, and then I issue myself 1 million shares of stock. And I own 1 million shares of stock out of a total of 1 million shares of stock. I own 100% of this company. And most companies start out this way, or maybe you co-founded with someone and you each have 1 million and there are 2 million total outstanding. And then you make some progress, you set a price, and you sell some stock. So let's say we set the price at $1 a share, we sell 1 million shares, and so we get $1 million for that. Now there are 2 million shares outstanding. I have 1 million. The investor has 1 million. Now I only own 50% of the company. Okay, so this is how equity financing works. Whenever you sell stock, you're just printing more stock, but that's added to the denominator by which you divide the amount that you have. So that's how equity financing works. It's not really any more complicated than that. So there are lots of things that equity investors look for, and I'm not going to read this chart, but it boils down to a balanced view of the company. Are you serving a big market? Do you have an experienced team? Where is your next finance going to come from if it's not going to come from me, the financier? How long is it going to take you to get a product to market? What are the risks? Sophisticated investors have their own list of questions that they'll grill you with, that they'll expect you to answer in both a business plan and a presentation. So if you're going to get equity investment, you're going to have to understand what it is that these equity investors want to know and prepare yourself to answer all of those questions. And improve the aspects of your business that fall short of what an equity investor might want to see. One side note, very often the first money, it certainly happened in my case and every venture I've been part of, the first money that comes in, equity money, actually comes in a convertible note. It's actually debt. So they'll write a check for $300,000, and then there will be terms under which that later converts to equity. Maybe once you get more significant funding down the road, it's converted at some discount to that later price. And so that way you can get money without deciding what is this company worth today. You don't really have to price the stock in the company, which is a real crapshoot early in the development of a company. Generally, companies at an early stage are priced by tradition rather than value. That is, there's a certain range that angel investors expect companies at an early stage to be worth, and it's hard to go outside of that range no matter what you've done. So if you want to get some early money into a company, a relatively easy way to do it is with a convertible note. It's a very common vehicle for angel investors. Government grants. This works for high technology products. Generally, the National Institutes of Health, I think this year will give out $30 billion. Not all to small businesses, a lot of it to universities, but there's a lot of money out there from every government agency has a program for something called the Small Business Innovation Research, or SBIR program. They have solicitations 1 or more times a year. They have topics. You send in proposals, and if you're lucky, you get money. And it's very competitive. Maybe 1 in 10 on average proposals are funded, but if you have a good idea and you can present it well, then this is a good way to get money for your company. The nice thing about it is you don't have to give stock for this money. This is, as we call it, non-dilutive financing, not dilutive to your ownership in the company. But it can be a challenge to get. We get a lot of funding from the National Institutes of Health through this program. From the time you submit a proposal to the time you get money is 9 months or 12 months. So it takes some patience to work this way, but you can get a lot of money through this path. It's probably not suitable for most service businesses or simple products or internet companies, but anything in high tech, whether it's serving EPA or FDA, there's money out there for it. Founder financing. So here are some statistics. This Kaufman data. Kaufman is doing a study on businesses that were founded in 2004. Advanced Liquid Logic is actually one of the companies in this study. We were founded in 2004, so I answer their survey questions every year. And so during the first year of life, percentage of businesses with personal debt. Okay, so personal debt of any kind, 50% of the 4,500 or so businesses that they survey had some kind of personal debt, where a lot of that were credit cards. So you go and get a Visa card with a $10,000 balance, and that's how you finance your business. That's almost a third of the businesses in this whole survey. That's one of their primary sources of startup capital. You can see that down here, personal bank loan, 18%. This means they put their house on the line or some other asset. Usually a secured loan is the way a bank would lend money. Family loan, that is mom and dad, in 10% of cases provided funding for the business. My son aspires to be part of that statistic. I don't know if that's going to happen or not. So this works for, maybe you have the money for founder financing. For founders that have no dough, maybe mom or dad does. But there are other sources as well. You can get debt, but you're personally on the hook for it in most cases. Customer financing, this is sometimes called bootstrapping, where you don't get any investment in your business. You work at night or without salary for some time. You create a product or service that a customer can use. You get some early customers and use profits from these early products to expand and grow. There are all kinds of modifications of this, but again, if you have a business where you can make this one of the legs on your stool, it doesn't have to be all of the financing for your business, but if you can get some early customers that are paying some of the bills, that's a terrific thing. This is one that you should think deeply about how soon you can get there. This will work for service businesses, software, simple products. If you have a highly regulated product that has to go through clinical trials and everything, you're going to have to get money before you're allowed to sell to customers to develop your product or service. So this will only work for some kinds of businesses. Family and friends equity. Okay, so now you're selling stock in your company to family and friends. Interestingly enough here, a couple interesting statistics. And again, this is in the first year of life in this survey. Only 10% of all the companies surveyed had any equity financing at all in their first year of life, which means most businesses in their first year of life are not selling their stock to angels or even family. They're getting money from credit cards or nowhere, customers, whatever. So equity financing generally is more later stage, and it's no equity, then angel equity, and then venture capital later. You can see in the first year of life, 36 companies out of 4,500 got equity money from venture capitalists. So it's not zero, but it is 0.6% of these 4,500 businesses. So it's a relatively rare event for a very early stage company to get venture capital. And this is, again, things have gotten worse than this since 2004. And so your chances today are probably much less than that. Angel equity, again, an angel is very often someone who themselves was a businessman or entrepreneur that invests money directly in companies in exchange for stock in the company. There are also angel groups where they have an organized process for reviewing investments in companies, and they travel in packs. Angels generally invest, from $10,000 to a couple $100,000. It's not purely to make money with angels. There are other motivations as well. They want to give back to the community. They're interested in a particular problem, curing breast cancer, curing Alzheimer's. There's very often a personal reason for an investment by an angel, which makes getting money from angels a little bit easier if you have the potential for a personal connection there. So it's not all about the money. There are other issues as well. They're looking for making 10 or 20 times their money in 5 to 7 years, though, typically. So you have to have a plan that shows them how they're going to do that. Total investment in 2002, in the U.S., $15 billion was invested by angels and $21 billion by venture capitalists. In 2007, angels exceeded VCs. So an awful lot of money is invested in companies by angels. It's in smaller bites generally than venture capitalists do, but it's also easier to get. And so this is a great way to go when your company is at a stage where it's suitable for angel investment, which again is not often in the first year of life. Venture capital, there have been a couple of these courses on VC, so I won't go into detail here. But again, you're getting money in exchange for two things here. One is stock in your company, and the second is control of your company. Basically, venture capitalists won't invest unless they have a significant presence on your board of directors and significant control over how you as a company move forward. And it's for businesses with high potential, generally for businesses with people who have done it before. It doesn't work for, very small companies or restaurants or things like that. Although there are VCs that invest in restaurant chains, but not so much individual restaurants. Strategic partner financing. This is generally a large company that they're in a market, they want to look at a new technology, they want a next generation product. You can get cash sometimes for stock in your company, or other times in exchange for exclusive access to your technology in their market. So you're giving up market opportunity, future market opportunity to them in exchange for this cash. This works for patented technologies generally. Also where companies would maybe put in an investment in your company with a mind later to acquire you if things go well. They'll get a foot and the knee in the door early so that if what you're doing works out, they can come in later and acquire you. Loans, banks lend money, but not to you and me, not to early stage companies. Again, some of the statistics here, first year of life, most companies 0 in debt, 10% of companies $100,000 or more. So you can see a lot of the debt financing that goes into early stage businesses is credit card levels of money as opposed to anything too significant. Supplier financing is something for the later stage, but here when you don't pay in advance, you're borrowing money from your supplier and buying something terms net 30. I'll pay you 30 days after you deliver it, which is typical. That's supplier financing. And when I was in the contractor manufacturing business, we would give people a couple extra % on price if they would wait 90 days. And that's a lot. That it turns out if 50% of your revenue is material cost, that's a lot of money. So this, for certain kinds of businesses, this is a good way to go, but it is in the later stages. Private equity is, again, big VCs, and it's not very relevant to this talk. So those are the types of capital that are out there. You have to evaluate these alternatives. Spend your time on what fits best. Look to non-dilutive, non-equity sources first. Customer financing. How fast can you get that is always a question you should ask. Understand the time required to get to the capital. Grant funding takes 9 to 12 months after you write a proposal. Angel funding, anywhere from a couple of weeks to 12 months. It can happen fast, but it generally doesn't. So almost all these types of capital we've been talking about take quite a bit of time to get in the door. So understand the time that's required, understand the control aspects. Are you giving up control of your company? Are they going to expect a seat on your board of directors? What percentage of your company are they going to own? And how much cash do you get? How much will the value of your company be increased? How much ownership percent do you sacrifice? And again, don't just pick one alternative. Pick a few alternatives. Work these things in parallel. You don't know what is going to work and what isn't when you begin this process. So working more than one in parallel, I think, is fundamental to any financing plan. So very quickly, a couple of case studies here. Triverics was a medical equipment contract manufacturing company that a friend of mine and I founded in 97. We raised about $40 million. We bought a lot of companies that we merged into this RTP-based company. This was our sales growth over a few years. So we had a lot of very rapid revenue rise. So we got it up to about 50 million and a few hundred employees. Some of the lessons learned here, we successfully raised a lot of money, but we didn't necessarily make a lot of money for those investors. And some of the things that we learned here, first was this was when we founded the company, the .com boom was coming along, so we were competing with Pets.com or Sofas.com for money at that point, which was a little bit difficult. And then the .com boom went bust, and now bricks and mortar and contract manufacturing sounded pretty good to some of these investors. So even boring businesses, and contract manufacturing is pretty boring, can get money, lots of venture capital money. So it doesn't have to be technology-based business, it doesn't have to be all that exciting. It has to be a good plan and people that they think can execute. You have to make progress quickly if you're going to keep getting money. Progress in terms of revenue or profitability in particular. You should work toward profitability, first revenue, a customer, and then profitability as early as possible. Don't delay that if you have an opportunity for alternative business plans where you invest more in infrastructure and delay profitability, which is what we did at Trivarius. I don't recommend that now. The better path is to get profitable as early as you can. Then you'll need less money, you'll give away less of your company, there'll be more left for you and your early investors in the end. So capital efficiency matters. That means making the most of every dollar that you get and using the least dollars possible to get your company to a certain stage. And also, the terms and agreements matter. This was my first venture-funded company, and you start this and the pile of documents is this high. And I had been an executive for some time, and as an executive in a large company, paper comes in to be signed all the time. I would sign a leaf if it blew into my office. But the terms, the precise terms in these agreements really matter to who gets what in the end. And so you really need to pay attention for those things. And again, venture funds are looking for big markets and fast growth opportunities. They're looking for an engaged team with experience and a good business plan. If you can sell them, you can get them to invest in your company. Again, it doesn't have to be anything too exciting. This is current company, Advanced Liquid Logic, and as Joe said, basically we're taking a whole bunch of different kinds of medical equipment and medical assays, and eventually we'll have all that in a PDA-like device where we'll be able to do any complex set of testing on a little stick of your finger or a little bit of saliva in the privacy of your own home or in the doctor's office or whatever else. It's quite a fabulous technology that our founders invented here at the Pratt School of Engineering. This is our financing history. So this was an SBIR Phase 1 grant for $90,000 or something like that, was the first financing of the company, plus just a little sliver of angel money late that year we had to get some money to get our license out of Duke, to license the technology out of Duke. And then we raised about $1.5 million in angel funding and got another couple $1 million in grant funding. And more of the same over the years. So this is 2009, and so cumulatively now we've raised about $5 million in angel money, $2 million in partnership equity. We've got a few $100,000 in loans and about $15 million in National Institutes of Health financing. So we're at about the $25 million level now. We'll continue to get more grants later, and this is a very conservative plan. I think we'll probably have several $1 million in partnership development funding next year as well, but we're not spending that until we get it. So the idea here is this is about how much money it's going to take for us to get our product on the market, so we're maybe a year away from that right now. It all started very small, a $90,000 NIH grant and $175,000 on a convertible note from some angels in that first year or so. So I think we track a lot by what this Kaufman data showed and what can happen in the first year. Just a couple more points here. Build value in steps. Here's the example we already showed. Better than this, make a little more progress. set your price at $2 a share. Now, to get your $1 million, you only have to sell 500,000 shares, and you own 2/3. And so, if you can get $500,000 in grant funding, then you only need half that amount of money, and you can wait longer. So it's sort of any non-dilutive financing that you can get into the game alongside the equity funding is the best way to go. And it's also good to have equity funding alongside the grant funding, not just stick with the grant funding, because grant funding is lumpy. It takes 9 to 12 months. You have some now, you don't have some later. And if you want to keep a team working on a project, multiple sources, again, is the way to go. So make a plan and test it. Look for enough runway to get you to a point where your company is at that next stage of development, where you can excite that next level of investor or get a strategic partner interested. Build yourself a long-term plan. Look at least a few years out into the future. Test the plan by going and talking to experts, practicing your pitch, etc. Make it better, make it presentable and understandable, and then make it happen. So a few cautionary notes. There's only one reason for business failure. There are many reasons why this happens, but the only reason businesses fail is when they run out of cash. And so cash means survival, and that means multiple paths to cash of one color or another. The only time it's easy to raise money is when you have money. Every time I raise equity money, I go talk to a bank and see if they'll give me a loan. If you wait until you need money, you won't get money. Or if you get it, it won't be at a price that you'll want to pay. Always have a next source of finance ready to go. Make sure you understand how long it takes to get each kind of capital and plan well ahead. Particularly in these times, everything a startup has to do is quite difficult, but raising capital is really hard in this kind of environment. But it can be done. It can be done, and it can be done well with the right plan. Some dilemmas, particularly for equity investors: you must promise great things to get funded, like I'll pay you back 10 times what you gave me in 5 years. That's the traditional promise you make to an equity investor. But you must also deliver more than you promise, particularly in the short term. And so what is that plan that you show them? That is what you will be graded on. And so promising too much is dangerous. Promising too little, you don't get the money. So it's a tough one. There's no right answer. It's a dilemma. More funding means a greater probability of success, faster progress. You can sleep at night because you're not running out of money. But more funding also means sharing or losing control and a lower percentage ownership for you. In Triverics, I founded that company. My co-founder and I were 50% owners of that company the day we founded it. The year we put in the $40th million of equity, I owned about 1% of that company. So I had some stock options that went beyond that, but you are giving away both control and primary ownership in your company by taking that path of funding. You can't get funded until you have something, and you can't have something until you get funded. This is the ultimate in startup dilemmas, and so generally what you end up doing is working for no money for a while, and I've done that at least 3 times. Just to put it in context, remember that finance is one of many critical things that you have to do in a business. People development, strategy, market development, technology development, product and service delivery. So generally what you find yourself doing is this for a while, then that for a while, and then this for a while. You have to be a multitasker to some extent. But what I generally find myself doing is maybe a couple weeks at a time, I'm doing one thing or another, and then on to the next one. So generally, if the idea is good enough, the money's there. And I think particularly angel money, there are 500,000 in the US, 500,000 active angels. It's not a perfect market. That is, it's hard to find them. But there are a lot of them out there, and a lot of them aren't, it's not just about the money. They have other reasons for investing as well. There are, rules to the game and how companies are valued and what are the documents you use and those kind of things, and you have to play by those rules. Again, seek multiple sources of financing, 3 to 4 legs on your stool. We have angel funding, NIH grants, and strategic partner funding. We're looking at foundations next, Gates Foundation and such. So there are lots of sources of funding out there, and the more that you go for, the more that you'll find. This is a process, not an event. Again, you raise money, you do something else, you raise money, you do something else. Particularly if you have multiple legs on that stool, there's always some element of what you're doing that has to do with getting money in the door. We have 32 people right now. That's a lot of mouths to feed, so I spend a lot of time raising money. And then don't discover all the pitfalls to Finance 101 yourself. Team with an expert. Seek people in the community that have some experience doing this. Lawyers and accountants can point you to the right people or help you themselves, but don't try to do it all yourself. So that's a couple other charts here that'll be, they'll probably post this presentation on what the trade-offs are, what the timing are, some equity terms, and a couple other resources for you. So,
Any questions?
questions? Yes, ma'am.
With multiple sources of funding and some from nonprofit sources like NIH or potentially Bill and Melinda Gates Foundation, the exit strategy for these folks might be very different. How do you manage that?
Hey, Rich, can you repeat the questions for everyone back here?
So the question was, how do you manage different expectations for, say, investors that have invested in equity versus a nonprofit or a government agency? They would want very different things out of your technology or company. What we find is what NIH wants, for example, government agency funding healthcare projects, is they want to see the research that they fund commercialized. And so if we get a product on the market, even if it's not exactly the product that they funded, they will shout about that. So, and the program manager that funded that and managed that will be a hero for a day. So, they don't want to waste their money. They want to see the money that they spend improve healthcare, and that happens through commercializing products. So, I think in that sense, the government money is spectacularly aligned with the equity investor who, if we never launch a product, they'll never get their money out. So they want exactly the same thing. And I think, Gates Foundation, they want to solve world health problems. That only happens if that product is working in somebody's hands in Africa or wherever else. And so, again, those goals are really well aligned. We've made them believe it. That's the way we look at it too. We just got a $5 million grant from NIH for HIV detection in low resource settings, read Africa, and we're going to save millions of lives, I hope, with that. And that's another good thing you can do. It's not all about the money, right? Particularly in the healthcare business. Yeah?
How often have you turned down equity financing? You felt like they wanted too much equity for what they were giving you?
Fairly often. That is, the price matters. and control matters. One of the promises I made to our two technology founders is, I'll keep this thing funded, and I'll keep you in control. And so we've managed to do that. So we still control our board of directors, and we've been pretty well funded. And so we've had equity money on offer at half the price, that we put on the table, and we've said no. But we've been in the fortunate position of having more than one leg on our stool. At my previous company, Triverix, I probably would have said yes, and did. It really depends on how much money do you have, how badly do you need that next money, what are your alternatives? But it's a price-sensitive market, particularly now. I couldn't get equity money from a venture capitalist right now at half the price that my strategic partner paid, probably. So,
Let's take one more question.
sir.
You talked a little bit about the importance of having funding from different sources, angels and VCs. And so as an entrepreneur, how do you strike a balance between getting money from VCs that may take more equity versus angels who will take less equity but can provide you as much of expertise in what you're doing or provide the networks that you need?
I think, that's not really a choice you have to make, because generally angels fund early stages and VCs fund later stages. And so that choice is made by the nature of the funding and when it is available to you. You do, I think, make choices between equity and non-equity sources of funding all along that path. That's a choice that you make, and my recommendation is more sources is better. And angels, they want control, and their prices are not necessarily lower, but again, it's angels early, VCs late kind of thing, so you're not really making that trade.
All right, let's thank Rich. Thank you very much, Rich.